Welcome back to the Dinar Daily channel. Tonight, we're bringing you a series of significant financial developments that have been stirring up investor circles and have the potential to reshape the fiscal landscape for many who follow frontier market currencies. The narrative emerging from global finance suggests a potential convergence of factors, a moment that could redefine the value proposition of certain long-held currencies. It asks us to consider a scenario that was once viewed as purely speculative, a quiet, coordinated movement behind the closed doors of major financial institutions. The most compelling piece of recent information centers on the purported actions of banks across the United States. Reports circulating within financial commentary circles indicate that key U.S. banking heavyweights have begun to synchronize a new, unannounced exchange rate for the Iraqi dinar. This isn't a single isolated incident. It's being presented as a simultaneous alignment across multiple, significant Tier 1 institutions, signaling a possible deep-level operational readiness for a major currency shift. This quiet synchronization has many analysts suggesting that the long-discussed currency reset is moving from a theoretical possibility to a tangible, behind-the-scenes reality for individuals with holdings in the Iraqi Dinar IQD, Vietnamese Dong VND, or Zimbabwean ZIM notes. The current moment is being framed as a crucial period for heightened awareness and methodical preparation. The focus isn't on acting based on a public announcement, but rather on recognizing the internal groundwork that must be laid before any public statement. By staying attuned to the market's subtle signals and operational shifts, investors are being encouraged to ensure their personal affairs are in order, positioning themselves ahead of a potential once-in-a-lifetime financial transition. The last 48 hours have seen a surge of discussions amongst financial sector contacts, with the focus squarely on activity inside some of the largest U.S. banking powerhouses. Information from both employees and external service providers suggests that branches of major institutions like Wells Fargo, J.P. Morgan Chase, and HSBC in key U.S. financial centers have been subtly altering their internal foreign exchange screens. This kind of widespread yet discreet updating of the digital backbone of a bank's trading system is being interpreted as highly noteworthy. By veteran market watchers, the true significance of these reports is the apparent coordination across these diverse Tier 1 banks. Such systemic synchronization is not typically undertaken lightly or without a directive from a higher authority. Internal foreign exchange screens are the core mechanisms for how a bank prices, trades, and settles all real-time currency transactions, making simultaneous changes an operational event of great magnitude. This concerted effort implies a shared, pre-approved framework for the anticipated currency adjustment across the U.S. banking sector, while both the U.S. Treasury and the Central Bank of Iraq, CBI, have maintained official silence and not issued any public statements confirming a revaluation or rate change. The concurrent system updates hint at a deeper, non-public operational alignment. Industry specialists often point out that before any major currency event can be made public, the necessary technical infrastructure must be meticulously prepared. This ensures that when the official announcement comes, banks can seamlessly process the new rates without causing systemic disruption. The prevailing opinion amongst currency market analysts is that this latest surge of internal bank activity is far more than a simple rumor. It's considered a concrete indicator that active preparation for a rate shift is actively taking place. Many who track global currency markets believe that a synchronized rate update across major U.S. banks often represents the final preparatory stage before a public announcement, making the current timing exceptionally noteworthy. For seasoned analysts and traders, this is not a routine technical update that can be casually dismissed as standard clerical housekeeping. The synchronization across Tier 1 U.S. banks almost certainly requires some level of official authorization, implying that substantial foundational work has already been completed behind the scenes. This procedural alignment involves not just changing the conversion rate on a screen, but also ensuring that liquidity management, compliance checks, and settlement protocols are all correctly calibrated across an extensive global network of interbank connections. The sheer operational complexity means this is a highly controlled process. It's critical to remember that major banks operate within an interconnected global financial ecosystem. Their internal systems must be fully compatible and interact seamlessly with central banks, international clearinghouses, and global partners. Therefore, a coordinated rate shift of this operational nature cannot be reasonably attributed to clerical error or random chance. Insiders stress that when this level of institutional synchronization begins, it signifies that the fundamental financial infrastructure is being aligned to facilitate actual currency transactions at the new rates. This readiness moves the narrative beyond mere speculation and into the operational reality of how global financial systems manage and prepare for large-scale change. Investors who have been closely monitoring these developments are interpreting this coordinated activity as the clear signal yet that the market is approaching the final phase before the mainstream financial media eventually acknowledges the event. Historically, the most reliable indicators of major financial adjustments have often appeared first on internal bank screens, long before any press releases were formally issued. To many observers, this current wave of behind-the-scenes financial activity feels like a meticulously managed prelude to a public announcement that could dramatically shift the dynamics of the global foreign exchange market. For many years, the discussion around bank screen rates was often disregarded as a mere conspiracy theory or exaggerated chatter within online currency forums. Critics argued that even if banks had access to internal rate previews, such non-public information would never be actionable or meaningful for the broader public market. However, that long-held skepticism is now facing a substantial challenge as multiple credible insider testimonies emerge with consistent reports. These sources emphasize that the level of synchronization currently being witnessed cannot be fabricated, precisely because banks simply do not update their complex internal operating systems without explicit instruction and approval from higher governing financial authorities. The rigor and scale of the reported changes lend weight to the claims. In the past, speculators would often assert that rate changes had occurred, but rarely was there verifiable, corroborating evidence from multiple distinct institutions. What makes the present moment different is the level of validation originating from diverse sources, who are all confirming that the internal alignment of forex rates is one of the very last steps before a controlled rollout of a new value. This final preparation stage represents a significant operational threshold. In practical terms, this internal alignment signifies that the core infrastructure has been meticulously fine-tuned and the systems thoroughly tested. The only remaining component is the public announcement that will formally move these hidden, synchronized changes into the light of day. For those who follow historical financial patterns, when multiple consistent insider accounts begin to confirm what speculators had long suspected, it often signals that the prolonged waiting period for a tangible movement is finally nearing its conclusion. The global financial environment in the current year, 2025, has created what many analysts are describing as a perfect storm for a currency revaluation, particularly one focused on the Iraqi dinar. Over the last decade, Iraq has weathered significant political and economic instability, factors that historically undermine global investor confidence in its currency. Nevertheless, recent trends suggest the nation is methodically moving beyond the persistent turbulence that once defined its financial profile. Crucially, Iraq's oil exports, which form the foundation of its national economy, have achieved a level of sustained stability, now reportedly exceeding 4 million barrels per day. This consistent stability is a major accomplishment, especially given the historical volatility in both production and export capacity, which was often hampered by regional conflicts and severe infrastructure challenges. As global demand for energy continues its upward trajectory, Iraq's role as a vital supplier has become more entrenched. securing a much stronger and more predictable financial outlook for the entire country. International buyers have also demonstrated increased confidence in long-term supply commitments from Iraq. This enhanced reliability has allowed the nation to significantly boost both its national revenue streams and its foreign exchange reserves. These positive economic developments not only significantly enhance Iraq's overall credibility on the global financial stage, but also provide the necessary financial foundation required to undertake meaningful and impactful monetary reform. Investors and global policymakers are increasingly recognizing that Iraq is no longer in the fiscally fragile position it once was. Instead, the country appears to be standing at the threshold of a significant economic transformation. Equally important to this positive shift has been the determined approach of the Iraqi government to comprehensively restructure its monetary and fiscal policies to meet international standards. In recent months, the Central Bank of Iraq, CBI, has been publishing policy papers that consistently emphasize three fundamental themes: digital alignment, currency modernization, and inflation control. Each of these concepts carries significant weight in global financial circles because they directly align with the necessary prerequisites for a potential revaluation or redenomination process that would strengthen the currency's value. These actions are viewed as foundational steps. Digital alignment suggests a concerted and systematic effort to fully integrate Iraq's banking and financial infrastructure with advanced international systems. The goal is to ensure that transactions are faster, more transparent, and globally interoperable, reducing reliance on outdated physical systems. Currency modernization implies the development of innovative tools and reforms intended to make the dinar a more attractive and viable asset for foreign investors while reducing the nation's reliance on outdated, cash-based transaction models. Finally, the explicit focus on inflation control speaks to a firm commitment to stabilizing domestic purchasing power, which is a non-negotiable requirement for any country seriously considering the deliberate strengthening of its national currency. Financial insiders argue that these deliberate policy moves are not random coincidences. Rather, they are carefully sequenced preparatory steps designed to create the absolute optimal economic conditions for a major currency rate shift to occur smoothly and with minimal disruption. When all these official policy signals and economic data points are collectively interpreted, they paint a clear picture of a nation that is systematically aligning its entire monetary framework with the stringent requirements of a more competitive and globally integrated economy. The element of timing, as any experienced investor can attest, is arguably the most crucial factor when it comes to the execution of currency reevaluations, which are high-stakes, controlled events, unlike ordinary market shifts that typically occur gradually or with some level of predictability. Currency reevaluations are executed in a highly controlled, precise, and discrete manner, often without any substantial prior public warning. Governments and central banks fully understand that sudden and massive shifts in currency values can unleash waves of unwanted speculation, arbitrage opportunities, and potential instability if the process is not managed with absolute precision and secrecy. Therefore, these significant financial events are almost always timed to coincide with a period when both domestic economic conditions and the international financial environment are perceived as being most favorable. In the present moment, the global stage appears to be aligning in a way that makes 2025 an exceptionally strategic window for such a move. Coinciding with various international economic recalibrations and geopolitical shifts. In the United States, negotiations over the debt ceiling and other large-scale fiscal policies continue to influence world markets, creating a background of global economic uncertainty and flux. Meanwhile, global economies are undergoing a broad recalibration in response to shifting trade balances, persistent inflationary pressures, and ongoing geopolitical risks. Against this complex backdrop, Iraq's bolstered foreign exchange reserves and stable oil exports provide the necessary economic buffer to successfully withstand any immediate financial shocks from a currency adjustment for global investors. This specific convergence of internal Iraqi reforms and external global conditions suggests that the timing is not only highly favorable but perhaps even deliberately chosen to maximize the outcome. When major U.S. banks begin synchronizing exchange rates in parallel with these specific global conditions, many interpret it as far more than mere coincidence. They see it as the final, compelling indication that the long-anticipated moment of revaluation is indeed moving to the near horizon. Dr. Khalid al-Sudani, a respected Iraqi economist who frequently advises parliamentary committees, recently commented that Iraq's methodical movement toward exchange rate stability cannot be viewed in isolation from its broader efforts toward international financial integration. His analysis strongly underscores the reality that Iraq's economy, while historically shaped by domestic political struggles and regional conflicts, is now becoming increasingly tethered to powerful global financial currents and standards of trade. Dr. Sudani's commentary highlights that Iraq has reached a point where its national currency no longer functions merely as a local tool of exchange, but rather as a profound symbol of its substantial economic potential within the global marketplace. For decades, the true intrinsic value of the Iraqi dinar has been artificially suppressed, primarily as a result of international sanctions, periods of severe political instability, and internal economic mismanagement. Yet, as Dr. Sudani emphasizes, the on-the-ground reality, particularly the robust performance of Iraq's oil exports and its growing foreign currency reserves, strongly points toward a far stronger intrinsic value for the dinar. He notes that the continued artificial suppression of the national currency actively undermines Iraq's overall credibility with international investors and severely hampers the country's ability to engage in large-scale, necessary infrastructure partnerships. In his professional view, the dinar must undergo a gradual but decisive shift to accurately reflect its true oil-backed strength, bringing its value into alignment with global norms rather than letting it linger as a distorted relic of past turmoil. For many who closely follow his economic work, Dr. Sudani's recent statements suggest not only the inevitability of a change but also a sense of urgency. Delaying the revaluation risks locking Iraq into long-term economic stagnation, while a measured adjustment could propel it into the ranks of stable, investment-friendly nations. Michael Grant, who previously served as a senior advisor within the U.S. Treasury and now consults with major global banks, frames the current internal chatter with stark, professional clarity. He maintains that bank rate synchronization is not speculative but rather a strictly procedural process. In his extensive experience, the internal alignment of exchange rates across various Tier 1 banks is never a frivolous act or a mere gesture of guesswork. Instead, it is always part of a carefully orchestrated, controlled sequence that must precede any major financial adjustment. Grant explains that these synchronization exercises are specifically designed to eliminate potential systemic shocks by ensuring that banks can seamlessly and instantly process a high volume of new transactions the moment an official new rate change is formally declared. He adds that this highly procedural stage is almost always completely invisible to the public, but for those intimately familiar with high-level financial operations, it is one of the single most reliable markers that a significant and imminent shift is about to occur. Grant further points out that the simultaneous involvement of both major U.S. institutions in coordination with foreign central banks, such as the CBI, demonstrates a profound level of bilateral trust and comprehensive readiness that cannot happen by accident. However, he also wisely cautions that while synchronization is undeniably a necessary precursor to official announcements, it is not the announcement itself. Investors must therefore balance their inherent optimism with a measure of realistic patience, recognizing that the exact public timeline remains a closely guarded secret to actively prevent any premature market distortions. Still, in his own words, the fundamental machinery is already in motion, and he suggests that machinery of this scale and complexity rarely stops once it has begun its predetermined Operational sequence. Linda Powers, a veteran currency market analyst renowned for her expertise in frontier and emerging market economies, offers what is perhaps the most investor-focused interpretation of the current wave of events. Helping to place it in a broader context, she describes the current period as a make-or-break moment for investors in global currencies, noting that several historically undervalued currencies appear to be rapidly approaching structured and coordinated rollouts of new values. Powers specifically highlights the Iraqi Dinar (IQD) and the Vietnamese Dong (VND) as the two most likely candidates for revaluation, citing their respective government reforms, foreign exchange policy adjustments, and their increasingly important regional economic roles. She also points to the Zimbabwean dollar (ZIM) as a potential, albeit high-risk, inclusion in what she refers to as a broader basket alignment strategy. According to her detailed analysis, such basket adjustments are entirely consistent with ongoing, quiet discussions in international finance about a global recalibration under a so-called global reset framework. These movements are rarely isolated financial events. When one currency shifts value, others are often restructured in tandem to maintain a necessary balance within international trade and global settlement systems. Powers explains that for investors, the coming period represents a convergence of both substantial risk and extraordinary opportunity. Those who are already positioned with strategic holdings could benefit significantly, but those who misread the complex timing or overleverage their positions may face serious disappointment. She concludes that while rumors and speculation will always circulate endlessly in this space, the undeniable convergence of bank synchronization, official policy signals, and resource-backed national strategies points toward one clear fact: change is no longer a matter of if, but a matter of when. While the Iraqi dinar has understandably captured the majority of the attention in the revaluation debate, the Vietnamese Dong (VND) also deserves close attention because of its own unique and powerful economic fundamentals. Vietnam has spent the past decade pursuing aggressive economic reforms that have fundamentally transformed its geopolitical position within Asia and the broader global economy. Once a largely agrarian society heavily reliant on external aid, Vietnam has successfully reinvented itself as one of the fastest-growing manufacturing and export hubs in the entire world, with the widespread acceleration of global supply chain diversification across Asia, particularly as multinational companies seek robust alternatives to manufacturing in China. Vietnam has emerged as a prime, attractive destination for massive foreign direct investment. Multinational corporations across sectors ranging from advanced electronics to textiles are rapidly scaling up their operations, thereby creating a sustained and structural demand for the dong currency. Analysts argue that this robust and growing manufacturing base, combined with disciplined fiscal management, provides the perfect foundation for currency appreciation. Speculation within investor communities suggests that a potential revaluation could see the dong approach parity levels, which would dramatically uplift the value of current holdings. Although credible economists uniformly warn against assuming any exact figures, regardless of speculative targets, the underlying point remains clear. Vietnam is not simply riding a wave of speculative hype, but is actively capitalizing on deep structural economic growth, strong trade balances, and an increasingly sophisticated, digitalized financial system. If Iraq signals a shift, many experts fully expect Vietnam to follow, ensuring that the dong secures its rightful place among Asia's emerging powerhouse currencies. Few national currencies carry the historical baggage that the Zimbabwean dollar, ZIM, does. For many, the word itself immediately conjures stark memories of hyperinflation, so severe that trillion-dollar notes effectively became nothing more than worthless souvenirs. Yet, recent surprising developments suggest that Zimbabwe may be methodically preparing for a remarkable financial resurrection. Moving to regain fiscal credibility on the world stage over the last several years, the country has quietly begun a comprehensive restructuring of its entire financial framework. specifically aiming to move decisively away from the reckless monetary expansion that once devastated its national economy. Central to this new, ambitious strategy is an explicit focus on resource-backed stability. Zimbabwe is richly endowed with abundant natural wealth, particularly in gold and other strategic minerals, and policymakers have been increasingly tying their new monetary policy directly to these tangible assets. By actively leveraging its gold reserves and welcoming targeted, strategic foreign investments, the country is carefully creating the financial scaffolding for a more credible and stable currency system. For speculative investors, Zim bonds and notes have long represented a high-risk, high-reward gamble. However, if Zimbabwe manages to successfully integrate this resource backing into its new monetary policies, the potential long-term payoff could be truly extraordinary. Analysts argue that the deliberate inclusion of the Zim in a broader currency revaluation basket would not only offer a form of redemption to those who maintained faith in the currency, but would also symbolize a wider global shift toward credible, resource-backed financial models in emerging economies. While substantial risks remain, including ongoing political volatility, persistent governance challenges, and global skepticism, the potential upside has made ZimInv one of the most talked about wild cards in revaluation circles, attracting significant attention from adventurous speculators. For US-based investors, the quiet, synchronized updating of bank screens across giants like Wells Fargo, Chase, and HSBC serves as more than just a dry technical update. It is being interpreted as a direct call to readiness. Although no formal public announcement has yet been issued by the U.S. Treasury or the Central Bank of Iraq, CBI, the sheer scale of the coordination strongly implies that the long wait for a potential revaluation, RV, may finally be approaching its final conclusion. For many who have tracked this story for years, this is the definitive signal that preparation must shift from passive expectation to a state of highly active readiness. The first, most immediate, and absolutely essential step investors should be considering is thoroughly verifying their holdings. Authenticity is paramount in this area, particularly because there have been reports of counterfeit notes circulating in the past. Investors must ensure that their IQD, VND, and Zim notes are genuinely authentic, properly documented with purchase receipts, and securely stored in a safe place. This process is not just about physical possession, but about legally ensuring that when the time comes, these specific assets will be fully eligible for exchange under official, regulated channels. The second critical measure is thorough document preparation. Investors should ensure they have updated, valid government-issued identification, comprehensive receipts of purchase for all currency holdings, and clearly organized bank account details that will facilitate a seamless and efficient exchange process. Those who are disorganized or unprepared may find themselves facing unnecessary delays or potentially being excluded from early exchange opportunities. Equally important is the ongoing effort to stay informed, focusing exclusively on credible financial updates from verifiable, regulated sources rather than relying on unreliable online rumor mills, which frequently distort timelines or artificially inflate expectations. Investors should also exercise an extremely high degree of caution. The currently heightened anticipation of a revaluation has unfortunately opened the door wide to various speculative scams, false promises, and outright fraudulent investment schemes. History consistently shows that during times of intense financial excitement, opportunists invariably prey on those who allow their excitement to override their critical discernment. Thus, true readiness is not only about preparing the physical assets, but also about maintaining unwavering vigilance, strategic patience, and professional discipline for those who adhere strictly to these principles. The coming financial transition could represent not merely a profitable payoff but a true, once-in-a-generation financial turning point. If the current synchronization of bank screens is indeed followed by an official, public launch of new rates, projections from various analysts suggest significant and dramatic shifts in valuation across the involved currencies. For the Iraqi dinar, IQD, while estimates vary widely depending on the analyst's modeling assumptions, many experts place the initial revaluation range between $1.95 and $4.25 per US dollar. Such a profound adjustment would instantly transform the dinar from a suppressed, undervalued currency into one that more accurately reflects Iraq's substantial oil-backed national wealth and significant foreign reserves. For the Vietnamese dong, VND, projections suggest a potential alignment between 47 cents and $2.10 per US dollar, representing a deep shift that fully reflects Vietnam's rapid economic modernization and its expanding role as Asia's primary manufacturing hub. Meanwhile, the Zimbabwean dollar, ZIM, is widely expected to be managed differently, likely through structured contracts and unique payout mechanisms that may not be directly reflected on open forex markets in the same way. Analysts note that ZIM's potential value lies less in its nominal exchange rate and more in its integration into carefully structured settlement baskets that are backed by the country's gold and other valuable resources. Long-term, the implications of these changes extend far beyond simple revaluation figures. A genuine global currency reset, if this is indeed the coordinated event many insiders believe it to be, could fundamentally reshape investor portfolios worldwide, offer a pathway to stabilize debt-heavy economies, and unlock entirely new avenues for international trade and commerce for major global economies like the United States. Such a fundamental recalibration may offer innovative tools to help rebalance national debt, strengthen cross-border settlements, and renew crucial confidence in global markets. However, analysts also caution that the immediate aftermath of such widespread changes will likely be turbulent. Experts predict a volatile adjustment window of approximately 12 to 18 months as markets seek equilibrium. Liquidity balances are recalibrated and trade partners worldwide realign their agreements. Throughout this predicted transition period, both significant risk and extraordinary opportunity will present themselves to investors. Those who remain disciplined, patient, and forward-looking are far more likely to emerge with stabilized, long-term gains, while those who overreact or attempt to chase short-term speculation may find themselves vulnerable to costly missteps. In essence, the financial projections highlight not just a set of specific numbers but a broader economic evolution that possesses the potential to redefine the global financial order as we know it today. Every major financial opportunity throughout history has been met with initial doubt, fierce resistance, and often outright ridicule before it was finally realized. The transition from gold-backed systems to fiat currencies, the explosive rise of modern credit markets, and the sudden emergence of Bitcoin all faced massive waves of public skepticism and mockery. In each of these past cases, critics often dismissed the possibilities as pure fantasy, only to watch from the sidelines as the early adopters reaped life-changing rewards. Today, holders of the Iraqi dinar, IQD, Vietnamese dong, VND, and Zimbabwean dollar, ZIM, stand at a similar and compelling financial threshold. The mounting chatter around bank synchronization, government policy reforms, and potential basket alignment strategies may still sound speculative to some, but to others it represents the clearest evidence yet of imminent, large-scale change. The critical difference between ultimate success and profound regret often comes down to personal preparation, unwavering vigilance, and the courage to act decisively. Those who are fully ready, both financially and mentally, are perfectly positioned to act with confidence and clarity when the opportunity becomes tangible and public. Conversely, those who choose to dismiss the current signals or hesitate out of fear may find themselves relegated to the sidelines, later reflecting on what might have been achieved. Investors should recognize that they may not merely be holding pieces of paper or digital balances. They may be holding tickets into a truly transformative chapter of modern financial history. The Iraqi dinar, long dismissed by mainstream critics as a speculative gamble, is increasingly being framed as a powerful case study in national resilience and economic reform. The Vietnamese dong, strongly backed by structural economic strength, stands as a testament to how emerging markets can successfully reinvent themselves on the global stage. The Zimbabwean dollar, once completely written off by the world, may yet symbolize the potential of resource-backed monetary models in a world increasingly hungry for financial stability. Each of these currencies represents not only risk, but also the profound possibility of generational wealth, the critical decisions being made today whether to diligently verify holdings, meticulously prepare documentation, or simply cultivate disciplined patience will ultimately determine whether investors fully participate in this historic shift or look back on the moment with regret. History is often said to reward the bold, but it most certainly favors those who are thoroughly prepared. As this reported financial reset edges closer to a public announcement, the message for viewers and investors remains simple and clear: readiness is not optional. It is destiny. We remind all viewers that this report is strictly for informational purposes and does not constitute formal financial, investment, or legal advice. Currency revaluation is a highly speculative field, and any financial decisions should be made only after consulting with a licensed financial advisor.